Let's talk about it further with our featured guest of the morning, a very familiar face to viewers of this channel. John Zechner is founder and chair of Zechner Associates. John, thanks for coming in.
What a morning to be here.
What a morning to be here indeed. What's your take, first of all, on the negative tone of futures market? What's that telling us about the mood of investors?
Well, it was just such a dramatic move to the upside yesterday that giving back a little of it, you put the 2 days in perspective, it's still a pretty massive gain off the low. So, I think a lot of it was positioning. I mean, hedge funds have put on a lot of short positions in the ongoing selling, and it was pretty washed out. So it wasn't going to take much to put a bit of a reversal to the upside, but it was how dramatic it was. So yeah, I think cooler heads are prevailing a little bit more today and thinking about, some people will take a profit on that. I think it's a great opportunity for the average investor to sort of now rethink, because, Paul, if the average investor, if the past month has made you think, okay, I have to revise my retirement plans or make some other changes in my life, you know what? Your equity exposure was too high. So maybe take this nice little bounce back where suddenly prices are looking a little better and lighten up and get to a position. I mean, we're sort of on the other side. We were pretty cautious, so we've been net buying into the past week and all this weakness. And I'll ride that. And if we sort of retest those bottoms, we'll probably buy some more. So it depends. But I think it's always a good time for investors to reassess where they stand. And this gives you the opportunity. You're not necessarily then selling at the lows.
You are going to talk to our viewers in a subsequent conversation about how to recognize market bottoms, so we won't do that now. But you've also put together some thoughts on this bear market compared to bear markets of the past, particularly the one that happened very abruptly in late 2018.
Well, yeah, Paul, it's like, is this a repeat of, and we sort of came into that year thinking this could look more, 2025 could look a lot more like 2018 than 2017, where it was sort of a straight up year. And we thought the risk, obviously, from trade and a few other things were front and center on top of the valuations. But I think there's a big differences that make me worry a little bit more that we won't get the rescue this time around that we got at the end of 2018. One is that it's not just China, it's global in nature. We started with Canada and Mexico, put in the EU, and then we saw Japan and everybody else. And I mean, the crazy formula they're using to put, 45% tariffs on Vietnam and everything else. So, that's a bit of a worry. The economic situation is totally different. In 2018, you had just, hit the Trump tax cuts. You had big corporate tax cuts where you're going to stimulate earnings growth. You had the consumer as well. So you had more tailwinds at your back economically. Now it's sort of the other side. You get a deficit in, a non-recessionary environment running 6% of GDP, which is unheard of. So you've already got a lot of, that gas tank is pretty much empty. You got a lot of stimulation out there already. So the economy is not going to be, you're in a different spot. So, economically it's going to be tougher as well. I think you're more likely of a recession than we're going to see before the end of the year. And even within Trump himself, and I hate getting into politics too much, but he had some strong personalities, good backgrounds and all of that first time around. And but he didn't end up, he listened to them a little bit, then he fired a lot of them. This time, I don't know whether I want to call them, acolytes or sycophants, whatever you want to say. Got a lot of yes men in there who are just sort of doing his bidding. And that makes me worry he's going to get away with more. And the most important part is that there is no Fed put right now. And I think that is because inflation was controlled in 2018. Remember that most of that prior decade had been, let's try to get inflation up to 2% because we're worried about deflation. Now we're on the other side of the coin. And so the Fed, I think, will stand on the sidelines. And if you remember, the Fed was what saved the market at the end of 2018 and make 2019 better. They sort of, you had the Fed put. They collapsed. They started taking rates back down after taking them higher. I think the Fed, and we're going to hear more of this in the next week or so as these guys come out, and the inflation numbers this morning, I think they're on the sidelines. And
in other words, they can't cut rates to stimulate growth, because if they do, they will fuel inflation, which is already higher than they would like.
Exactly. They don't know which way they're going. When you're in a dark room and you don't know whether to go forward or backwards, stand still. And I think that's exactly where the Fed is right now. So.